Market Prospects, delivering timely information and education to prairie farmers for over 25 years. Market Prospects is brought to you by the University of Saskatchewan's Department of Bioresource Policy, Business and Economics, and these sponsors. Log on to marketprospects.usask.ca to view past programs and for information on upcoming programs.
In this week's Market Prospects segment, we get the U.S. perspective on the grain and oilseed outlook. Once again, we're privileged to have as our guest Dr. Joseph Glauber, the Chief Economist with the United States Department of Agriculture. Welcome, Dr. Glauber.
Thanks very much.
Well, last week you provided us an overview of the current and expected global supplies, demand, and prices for cereal grains and oilseeds. Has a slide in ag commodity prices impacted U.S. farmland rental rates, input costs, and land prices?
You're absolutely right about the price slide, and it certainly has created a little bit of stress for farmers who locked in rents last year at pretty high levels and at record levels, certainly in nominal terms. We have seen some farms that have been trying to adjust rents. A lot of these rental contracts run for 2 years, so I expect that when we look at the numbers later in the year, that we'll continue to see some pretty high rents. Insofar as land values are concerned, they're at record levels, at least in nominal terms, and really they're close to record levels in adjusting for inflation as well. The U.S. ag economy added, I think, about $1 trillion over the last 5-6 years, and most of that was in terms of inflation, in terms of land values. We haven't really seen the softening in land values that one might expect, and particularly with lower prices and higher interest rates that we're now beginning to see. So it wouldn't surprise me if I saw we started to see land values at least flatten a bit and perhaps even fall a little bit over the next year or two. Again, presuming that we're continue on this path of lower prices.
So what's the acreage and current condition of the U.S. winter wheat crop, and what factors will influence the production potential for the crop that is in the ground?
Yeah, two things. One is I may have mentioned last week that we had smaller wheat seedings this year, mainly in the western part of the country. If we're looking at a lot of the West right now continues to be in drought, and for those of you who follow the U.S. situation, particularly in the southern plains and the southwest portion of the U.S., we've had some very, very dry conditions over the last 3 years. California right now is in a record drought, at least from dating back to when we started collecting these drought magnitude statistics. So there's a lot of concern over, one, what sort of moisture conditions the wheat will see when it emerges this spring. But then we've had, because of these blasts of cold air that have been coming down out of the Arctic this winter, and it's been a very cold winter in the U.S. at least, particularly in the midsection of the U.S., that there's, luckily this last blast that came, we had a good snow cover, but there is concern that we've seen some freeze damage. And of course, we'll know a lot more over the next month or so. We'll restart with our crop conditions reports. Right now, they're just done on essentially a monthly basis out of some selected states. But we'll get a little better picture of that, by the time we're in March or April.
So what's the soybean to corn price ratio? How does it affect the size of the U.S. corn, soybean, and wheat crops? And what do you expect for acreage of those crops this year?
Well, the soybean corn ratio really has been favoring soybeans. Typically, it used to be 10, 15 years ago, we thought the break-even point, if you will, was around 2.5. That's probably closer over the recent years more to 2.2 or so. But we're currently running a soybean corn ratio of 2.5. That would certainly favor soybeans. I might add, when Brazil and Argentina were doing their planning, the soybean corn ratio for their harvest months was closer to 3. So that was really favoring soybeans, and I think we've seen that already. And I expect that we'll see that here in the U.S. as well. The recent farm bill that was passed in the House and will retain a lot of the decoupled features that the current farm bill has. So we shouldn't be seeing any real influence of the farm bill per se on plantings. And I think so it will basically come down to those price levels. So I think that what that means is probably soybean acreage a little closer to 80 million acres, up from the 76.5 million. I don't know if we'll hit 80 or not, but we'll certainly be closer to 80 than the current level of 76.5 million acres. And for corn, we were at 96.5 this year. We were at 97 and change last year. I expect as we're going forward here that we'll probably be closer to 90, 91, somewhere in there. You never know. As this moves towards planting time, things can happen like rains and things like that which can shift acreages and not small amounts of acreage into other crops. But right now, I think that certainly prices alone favor soybeans, and I think we'll see that in the planting intentions. Our planting intention survey comes out March 31st, and that will be closely watched by the markets.
So what areas of the new U.S. Farm Bill would be of special interest to Canadian prairie farmers?
Well, I think generally what you see in this Farm Bill, particularly for the commodity programs, is we've moved away from a lot of the old price support programs and moved into more augmented insurance products. And so these are essentially revenue type products that producers can purchase and in some cases get as part of their commodity programs, where they will pay for a loss between up to 85% of the coverage of their revenue. But as revenues go down, so too do these guarantees decline over as well. So they will follow the market in that sense. So I think that certainly would be of interest to Canadian farmers. Our dairy program has undergone a big change. We will move away from price support programs entirely and move more to a margin type program where producers will pay, in one sense, they'll pay a premium for some coverage of their margin between their milk costs or their milk receipts and an underlying feed cost. So that's a big change. There's a lot of the program. It changes a lot. We'll see some budget savings, probably closer to $10-12 billion on the mainstream commodity programs. Still a lot of money going into that sector, mainly through the insurance program.
What is currently happening with U.S. biofuels policy and legislation?
There's been I think a change. Certainly in the biofuel market, we've been pretty flat in terms of ethanol consumption over the last, I'd say, 3 or 4 years. And for the first time this year, the Environmental Protection Agency, which is the regulatory agency that sets the mandates under our Energy Act, instead of increasing the mandates for biofuels, which is required under law, they are using some provisions in the law to essentially reduce that amount because of the lack of infrastructure to provide gasoline for vehicles that can take higher than 10% blends. And right now, the so-called blend wall at 10% of gasoline consumption is hindering further ethanol expansion. And I think for the time being, at least, we don't see much movement above and beyond the sort of 4 billion bushels or so of corn that are going into ethanol use.
Last question, is the U.S. having issues similar to Canada in getting grains and oilseeds to export markets?
We haven't had quite the same problems on quite the same problems with rail import that Canada has been having. However, there's been a big shift over the last few years of more and more grain moving out of the Pacific Northwest for the U.S. and less out of the Gulf, or at least in proportionate terms. And I think that could start to change a bit with the expansion of the Panama Canal, which is, the construction there is almost complete. We should see that changes in the next couple of years, I think, as larger ships will be able to pass through the canal. That will certainly make the Gulf ports far more competitive and probably draw grain and oilseeds from a bigger area than they were before. And so I think that will result in some changes in terms of grain flows within the U.S. But the infrastructure within the U.S. has seen some big changes, not just with increased port facilities in the Pacific Northwest, but also with ethanol production and the competition. We certainly have seen corn exports drop a lot over the last 5-6 years. The real big question is, will they come back to kind of the levels they were 10 years ago or so? And then obviously, if that's the case, are they moving out of the Gulf or moving out of the Pacific Northwest?
Valuable insights, Dr. Glauber. Thanks again for your time.
Yeah, no, thank you.
We'll return after a few messages. Please stay with us.